Hi guys, welcome to our YIS online club meeting this week. This week we're going to be going over Unit 6, Lesson 3, Determining Intrinsic Value of a Company. And this week I have with me Kavya. Kavya comes to us from Maryland, and she's going to be going over this lesson with you guys today. So whenever you're ready, Kavya, you can go ahead and get started.
All right. Okay. So today we're going to be learning about determining the intrinsic value of a company. So first, let's start with the idea of the week. So Tesla it can never stay out of the news. So Bitcoin and Tesla are both in the bear market now. So the bear market is technically defined by dropping 20% from its peak, which both Bitcoin and Tesla have done. So Tesla has dropped 25% since its peak, and Bitcoin has dropped from $58,354 to $45,000 from February 21st to February 23rd, dropping about 20%. So after Bitcoin reached a record high, above $58,300, over the weekend, the price movement started to trend downwards. And the drop was fueled by US Treasury Secretary Janet Yellen, who described Bitcoin as a highly speculative asset. So the whole cryptocurrency market dropped along with Bitcoin. And additionally, Elon Musk, who always throws gas on the fire, tweeted on Saturday that the price of Bitcoin seemed too high. Shareholders weren't too pleased because Musk's $1.5 billion investment in Bitcoin earlier this month. So Tesla also dropped its lowest price Model Y from production, coupled with multiple price cuts, which also contributed to the share price moving. So first, a refresher on what intrinsic value is the true value of the company, and your goal is to pick stocks that are trading below their intrinsic value. So today we're going to be using discounted cash flows method, which is one of the ways to approximate the value of a company. So to understand what the discounted cash flows method does, we first have to understand what a company's worth is defined by. So a company's worth is the present value of all net future cash flows. What this means is the value of a company today is the sum of all the cash flow they will earn each year in the future. But those future dollars are converted to today's money. So that way you can get an accurate gauge. So you may be wondering why you can't just calculate the value of a company by its net income or total sales. And just because a company has more revenue or net income doesn't translate to the company being more valuable than its competitor. A company is only worth the amount of cash it has left over after covering all of its expenses. So this is what net cash flow is. Net cash flow is the cash the company receives from its sales minus total expenses, minus money spent on equipment or assets to grow the business, which is called capital expenditures. And so net cash flow is equal to revenue minus expenses minus capital expenditure. This type of valuation is referred to as discounted cash flow analysis. So first, a question. So now that you know what the net cash flow is and why it can be used to determine the value of the company, let's say you're given the opportunity to choose to invest in either company ABC or XYZ. ABC has total annual revenue of $100 and is selling for $250 a share, while XYZ has total revenue of $80 and is selling for $300 a share. Which one would you buy? And the answer is that it depends. You can't judge whether to buy a company based purely off of its revenue. You would need to know the present value of its future cash flows, and then you could determine which company you would buy. So now let's find out how to do just that, finding the present value of a company's future cash flows. So I'm going to walk you through how to do a discounted cash flow analysis for a company. Remember, the discounted cash flow analysis is how you can determine the intrinsic value of a company, which is the present value of a company's future cash flows. So Young Investor Society has an intrinsic value spreadsheet on their website at the Stock Pitch Competition Resources. The link's on the screen, and that you can use to create your own DCF model for whatever company you please. But first, I'll show you how to use it. So this is what it looks like. This is a simplified version of a discounted cash flow model. And so let's see. First, a rundown before we actually get into putting the numbers in. So first, you're going to want to choose a company that you would like to estimate the intrinsic value for. But be careful, because you're using a company, if you're using a company that has a market cap less than $500 million, so that could be a small cap, micro cap, or nano cap stock, or anything below that, you may want to add a size premium of 2 to 4% to the company's weighted average cost of capital. This is to account for the additional risk involved in small companies and startups. But because a company's cost of capital is linked to its valuation, that's why you really need to take that into account. But for now, we'll stick to a pretty established company. I chose John Deere, the agricultural manufacturer. And so we're going to use Yahoo Finance today. You could also use Saks.com or any other place where you'd get information, financial information about a company, to input the information in the yellow boxes that we saw on the previous slide. And so another thing with the DCF model is you have to make multiple assumptions, because if you didn't have to make assumptions, then everybody would just be making money quick in the stock market, which is no, that doesn't happen. So you have to make assumptions about the future growth rates and the cash flow margin. So to make these assumptions, you want to look at the trends of the company has had in the past and think about if the future will be higher or lower. And then from there, you just have to make your best guess, because there really is no static number. So remember, the most companies have flat or declining margins over time because of competition and technological changes. So, and then over here, you can see that there's a terminal growth rate and the discount rate boxes in the key assumptions. So in most cases, you're going to want to leave the discount rate at 12% and the terminal growth rate at 4 or 5%. And play around with the assumptions, because when you do, you can see how the cash flow graph and intrinsic value calculation changes based off of the changes in these assumptions. And at the bottom of the spreadsheet, you'll see your intrinsic value calculated. If the intrinsic value is significantly above the current share price, then the stock is likely undervalued and you should go buy it. But if the intrinsic value is below the current share price, then the stock is likely overvalued. So let's get started. Okay. So first, we're going to be filling out the company name and the company ticker, just so that you can keep track of what you're doing. So this is Deere & Company, also more popularly known as John Deere. Oops. And their ticker is DE. And so their share price today is $345.66. And so for diluted shares outstanding, to find that, you're going to want to go to the key statistics, which is over here. And then you're going to scroll down to the, oops, sorry, diluted shares outstanding. Okay. Okay, that's in the share statistics over here at shares outstanding. And so it's going to give you that number. Over here, it's 314.42. So just put that in. And then you're going to want to give their most recent revenue next. So to find that, you're going to want to go to back to the key statistics and go to the income statement. And so I'll show you the revenue. But this sheet, just keep in mind, the sheet takes everything in millions. It says that over here, it says it takes it in millions. But for most big companies, it's going to give you their revenue in billions. So you're going to want to convert this number. So 1 billion is 1,000 million. So 36.99 billion would be 36,990 million. Next, you're going to want to get the most recent net income. We can also find this in the income statement section, next to net income available to commons. So this is 3.46 billion, which means it's 3,460 million. Next, we're going to get the most recent free cash flow. To get this, go to the cash flow section, which is over here. And it's the levered free cash flow, which is $3.2 billion, which is 3,200 million. So here's where it gets a bit tricky. We have to make a couple of assumptions to complete our analysis. So for the growth rate for the next 5 years, that's how fast you expect the company's earnings to grow on average each year for the next 5 years. You can estimate this by looking at a company's past growth, the industry's growth, and the market as a whole. You can look at that, but it's not as effective as looking at the company itself or the industry itself. You can also check analyst expectations and any other moving factors. So I expect Deere to increase by about 14.5% for the next 5 years, because the industry itself has had some pretty strong growth and the company too has shown some pretty strong growth. So I'm going to put this in as 14.5. And in most cases, like I said earlier, we keep the terminal growth rate at 4 or 5%. And the terminal growth rate is how fast you expect the company's earnings to grow after the 5 years to perpetuity. In most cases, we leave the discount rate at 12%. So what the discount rate is, it's the company's cost of capital. And from there, now we can see the intrinsic value per share. It's $208, which when we compare to the actual current share price of $345, we can see that it might be overvalued right now. And if we go check over here, it turns out a lot of analysts believe it's overvalued as well. Okay, so now let's play around with these assumption numbers, the growth rate, the terminal growth rate, and the discount rate. And when you increase the growth rate and terminal growth rate, we can see that the value per share increases. So let's change this to 16%. It changed. And let's change that back to 15. And let's change this one to 7%. You can see that changing the terminal growth rate makes it grow a lot higher, because that's how much the share is growing past those 5 years for a very long time. And when we increase the discount rate, so we'll take that back to 5, we can see that the share price decreases. Like that. All right, so that's how you use the discounted cash flow analysis. Underneath on the spreadsheet, you'll also see relative valuation analysis, and I'm pretty sure you're going to be learning about that next week. But so we can go back to the presentation. Wait. All right. So the intrinsic value calculation was most sensitive to changes. Oops. Okay. The intrinsic value calculation was most sensitive to changes in which assumption, the 5-year growth rate, discount rate, or terminal growth rate. And we could see that the terminal growth rate was the most sensitive because it was being applied over a bigger and longer course of time compared to the 5-year growth rate. And while playing around with the model assumptions about the value of a company, we learned that the company's value can vary drastically on the assumptions we make. So we have to make really thoughtful and careful and well-informed decisions on those assumptions, because most people say, like, it's a common saying with discounted cash flow analysis, that if you put garbage in, you're going to get garbage out. So if your assumptions are bad, your discounted cash flow analysis basically means nothing. So make sure those numbers, those assumptions you're putting in, are founded on facts. So for the third question, would you rather buy a very predictable company that had 20% upside potential, or a high growth company that has a 50% upside potential? Does anybody want to volunteer?
I would say it depends on the investor, their risk tolerance.
Yeah, that's a good answer. So you personally, what would you do?
Because I'm young and have time to kind of grow my capital, I'd probably go with a high growth company because if I'm in my 60s and I lose a lot of money, it's kind of a big deal because I'm about to retire. But if I'm 16 and I lose a lot of money, I'm going to have my professional career ahead of me to kind of build it back up.
That's a great answer. That's exactly what I was gonna say, what I would say as well. So that's it. I hope you enjoyed this lesson. Try doing a discounted cash flow analysis yourself. You can maybe find some hidden gems if you find some companies that are trading below their intrinsic value. And so once again, you can get that spreadsheet at the YIS resources page. And yeah, I hope you enjoyed.
Kavya, thank you so much. You made that seem effortless. And I really appreciate it. Very well thought out, very step by step. I'm sure it's going to be viewed many times on our YouTube channel because kids are getting ready to do the stock pitch competition. So very, very well done, Kavya. Thank you so much.
Yes.
Speaking of which, I just want to make sure you guys know stock pitch competition registrations are now open on the MyYIS portal. You go to calendar, you look for your state event, and then you register for your state event. All the state events this year will be via YouTube video. So all of the requirements are on our regular website, not the YIS portal. So you can see all of the requirements there and make sure that you have everything ready by April 5th. That's our deadline for stock pitch reports, stock pitch presentations, and YouTube videos. So until next week, you guys, next week we have one of our YIS ambassadors, Leon, joining us to do our relative valuation method. So that should be cool. All right, you guys, I'll see you next week. Bye.